In this video, I'm going to share with you 11 options trading tips that should help you become a better, more consistent options trader, especially if you're a complete beginner and you have no idea where to start or the things that you should be considering as a beginner options trader. These tips cover a lot of different aspects of trading, and options trading tip number 11 that I'm going to share with you is the absolute best piece of advice I can give to any trader, not even just options traders. So be sure to stick around for the entire video because you don't want to miss any one of these tips. My name is Chris Butler from projectoption.com, and if you're new to the channel, be sure to subscribe and enable notifications so you can get all of my options trading videos in the future. The first 4 options trading tips that I'm going to share with you are related to setting up and entering trades. Let's get started. Options trading tip number 1 is to use delta to choose your strike prices, and if you're a technical trader, you can use support and resistance levels to also help you choose strike prices for the option strategies that you're setting up. If you believe in trading around support and resistance levels, then using these levels to choose your strike prices, or at least using them as a starting point for choosing your strike prices, can help you come up with a system to set up your option strategies. For example, if you're trading credit spreads, which means you're selling a call spread or selling a put spread, using support and resistance levels can be a good way to choose the short strike price that you use in your credit spread. Let's look at an example. In this chart of Facebook, we can see that Facebook shares rallied up to $200 before quickly reversing directions and falling to about $160 per share. If a trader believed that $200 resistance level would hold in Facebook over the next 1 to 2 months, they could sell a call spread and profit from that outlook by placing the short strike of the call spread at or above that resistance level of $200. If Facebook shares stay below $200 over the next 1 to 2 months, and that resistance level holds, then that short call spread that the trader sold would profit, because if they place their short strike at or above $200 and Facebook shares remain below that resistance level, they would profit from the steady decay of that call spread, because those call options would be 100% extrinsic value, which would decay to $0 over time. And when you sell a call spread, if the stock price goes to $0, you will keep 100% of that premium that you received when selling that call spread. Now, sometimes you might not be able to use technical analysis to help set up your strategies, and if you're a trader like me who doesn't use any technical analysis in their trading, using delta to choose your strike prices is a quantifiable system that makes it much easier and streamlines the process of choosing strike prices for the option strategies that you commonly trade. For example, a trader might have an iron condor strategy in which they sell the 25 delta call input and purchase the 10 delta call input to complete their iron condor position. While delta is the estimated change in an option's price given a $1 change in the stock price, the delta of an option is also used as an estimate for the probability of that option expiring in the money. For example, I mentioned selling a 25 delta call and a 25 delta put as part of that iron condor strategy that I just mentioned. By selling a 25 delta call option, you are selling a call option that has an estimated 25% probability of expiring in the money at expiration, which means it has an estimated 75% probability of expiring out of the money at expiration, since the delta of 25 is the estimated probability of the option expiring in the money. So by using delta to choose your strike prices, you are incorporating probabilities into the way you're setting up each and every trade, and having a quantifiable system is way better than just winging it 100% of the time. So if you want to set up your trades and use probabilities, choosing strike prices with delta is a great place to start. Options trading tip number 2 is to trade options at liquid strike prices or active strike prices. In regards to opening trades and choosing strike prices, it's important to choose options at liquid strike prices with lots of trading activity gauged by high open interest and volume. Otherwise, you could have a very hard time getting filled on those trades, which is not ideal and could even be dangerous if you're trying to close a position that you've already entered and you need to close that position to stop the loss from getting larger. And if you can't close your trade before the loss gets larger because of liquidity issues, that's something you could have avoided by first trading liquid strike prices, which is why this is options trading tip number 2. Trading active and liquid strike prices should not really be an issue if you're already trading very active stocks or products such as Apple stock, SPY, which is the S&P 500 ETF, or something like IWM, which is the Russell 2000 ETF. Let's take a look at an example to show you exactly what I mean by this. In this image of SPX options, we can see that there are put options with very, very little open interest, while some of the put options have very high open interest. If I were to make a trade using these SPX options, I would be sure to use strike prices with high open interest as opposed to using strike prices with very, very low open interest, because by trading strike prices with high open interest, I know I'm pooled together with lots of other traders who have positions in those particular options. So when I want to open a trade and later close that trade, I know there are lots of other market participants that have positions in those options, which is going to make it easier for me to close my position. Using these options, selling the 28.75 put and purchasing the 28.50 put to create a put credit spread would be a trade that utilizes the most liquid SPX options in this particular case. Now, if I move those strike prices by one strike price and instead sold the 28.70 put and purchased the 28.45 put, that would be a put credit spread as well, just like the one that I set up before. But in this case, the options used have very, very low trading activity, which is a situation that I always want to avoid. Options trading tip number 3 is to mind your risk. As a beginner options trader, it can be very easy to focus on the profitability side of trades, such as looking at out of the money strangle positions or iron condor positions and fantasizing to yourself about how much money you could make by selling those positions and watching them expire worthless. But I would very much encourage you to focus on the risk side of things and not look at how much you can make, but always consider how much you can lose, because it doesn't matter what strategy you're trading, eventually you're going to have a losing trade, and if you ignore the risk side of the equation, that's not going to be a fun day for you. Just because you can make $1,000 selling that out of the money strangle that expires in 30 days, it does not mean that's a trade that you should put on, because that same exact trade over a long period of time will leave you with a significant loss if you're not focused on the risk side of the equation, and that one significant loss could easily wipe out all of the profits you experienced up to that point because you did not pay attention to the risk and you did not have a plan around what you would do when the position inevitably goes against you at some point. In the same light, just because a trade has a high probability of making money, it also does not mean that that is a good trade. Options trading is all about probabilities, and the risk and reward potential of any particular options trade is going to reflect the probability of its success. If you have a trade with a very high probability of making money, then that trade has small profit potential and a lot of risk. And on the other side of the equation, if you look at a trade that has a low probability of making money, that position is going to have just a little bit of risk and a lot of profit potential. Profit and loss potential of any options trade will reflect the probability of that trade making money, and just because a trade has a high probability of making money or a low probability of making money, it does not mean those are good trades. So always pay attention to the risk of a position and don't judge a position based on the amount of profit it can make or by its probability of making money. Options trading tip number 4 is to try and fill your trades better than the mid price and then adjust incrementally. If you're trading an option strategy that you have to pay to enter, try buying the position slightly below the mid price and then adjust incrementally from there. For instance, if the trade you're trying to put on for a debit, meaning you're paying to enter the position, and the mid price is currently $1.50, try to buy the position for $1.48 or $1.45, and then adjust upwards towards the mid price from there. On the other side of the equation, if you're trying to enter a trade that you collect a premium to enter, such as selling a call spread, and the mid price for that call spread is $1.50, try to sell that call spread for $1.52 or $1.53 and see if you can collect more than the mid price for selling that call spread. If you can't get filled, adjust the price you try to get filled at incrementally towards the mid price, and if you're selling an option, that means you will be reducing your price towards the mid price until you eventually get filled on that trade. But in general, if you try to fill trades better than the mid price, eventually you'll pick up some pennies here, some pennies there, and that's going to add up immensely over time. Options trading tip number 5 is to set a GTC order at your profit target right after you enter a trade. One of the decisions you have to make when trading any option strategy is when you will take the trade off for a profit. And once you enter a trade, if you set a GTC or good till canceled order at your profit target, you won't have to think about closing that trade if it reaches your profit target, which means that's one less decision you have to think about when you're trading options. The less decisions you have to make, the better. Options trading tip number 6 is to use multiple trade exit triggers, meaning when you enter a trade, there should be many different things you're looking for to determine when to close that trade, and it could be as simple as using a profit target, which I just mentioned. You could use a loss target. So if you use a profit target and a loss target, you now know when you will close profitable trades, and you now know when you will close unprofitable trades, which is incredibly important when you're trading any strategy and not even just options. Additional trade exit triggers you can use when trading options would be delta-based exits and time-based exits. And by using multiple exit triggers, you're adding a little bit more variety to the things that you're looking for that will determine when you close a trade. And instead of just having a profit target and a loss target, adding some additional exit triggers can help with consistency and potentially smooth out your performance over time. Many beginner traders struggle to have consistency with when they close trades, and quite frankly, a lot of them don't have any plan whatsoever for what they're going to do when a trade is on. I am no exception to this, because when I started learning options and I was trading, I was just throwing trades on with absolute reckless abandon, and I had no idea what I was going to do with the trades that worked out or the trades that did not work out, which is the more important side of the equation. I've learned through experience that having multiple trade exit triggers can improve with strategy consistency and performance, and it can also help you reduce the amount of decisions you have to make, therefore making it a much more pleasant experience when trading options. If you don't know this yet, trading should not be stressful, and if it is stressful, it's probably because you don't have a lot of rules in place that you're following for every single trade that you make. And by implementing some trade exit triggers, you won't have to think as much about what you're going to do with your trades once you've entered them, and that's going to make it a much more pleasant experience. There are 4 exit triggers that I believe can be applied to any options trading strategy. The 4 trade exit triggers are profit-based exits, loss-based exits, delta-based exits, and time-based exits. A profit-based exit is simply closing a trade when it reaches a certain profit amount, and personally, I like to use profit percentages as opposed to specific dollar amounts. A loss-based exit is simply closing a trade once that trade has reached a certain loss threshold, and I like to use loss percentages, meaning that if I sold a call option for $5 and the call options price increased to $7.50, I would consider that a 50% loss, because the options price increased 50% from my entry premium of $5. You can use whatever metric you want to use when calculating profits or losses, but I like to use profit percentages and loss percentages when using these 2 exit triggers. A delta-based exit is closing a position when one of the options reaches a certain delta level. For example, let's say my strategy is to sell iron condors on SPY, and I like to sell the call option with a 0.25 delta and sell the put option with a negative 0.25 delta, in which case I could use a delta-based exit strategy, meaning that I would close the iron condor position altogether if the short call delta or the short put delta reached a certain level. For example, since I started with deltas at the 0.25 and negative 0.25 levels, one of my exit strategies could be to close the iron condor if the short call delta increased to 0.35 or if the short put delta fell to negative 0.35. In both cases, the change in the options delta from 0.25 to 0.35 indicates that the market has moved against one of my spreads, and based on whatever delta you choose, my strategy would be to close the entire trade if that delta level was hit, and by doing so, I could re-enter the trade using my initial entry criteria, which means I would be recentering that iron condor and selling the new 0.25 deltas and closing the old trade, which is now closer to being in the money since the market moved closer to one of the spreads, as indicated by an increase in the short options delta. When using a delta-based exit trigger, you close the trade at whatever profit or loss that trade currently has when that delta limit is reached. No questions asked, just take the trade off when that level is hit. The last trade management trigger that I mentioned is the time-based exit, which is simply closing a position after a certain amount of time has elapsed. For example, if I sell iron condors on SPY and I sell them with 60 days to expiration, or whatever expiration has closest to 60 days until expiration, An example of a time-based exit would be to close the iron condor no matter what after 30 days in the trade. So if I'm selling 60-day iron condors, that means my rule is to hold the trade for a maximum of 30 days, meaning the iron condor will have somewhere around 30 days to expiration, at which point, if my profit or loss or delta-based exit triggers are not yet hit, I will take that trade off because 30 days have elapsed, and with the iron condor getting closer and closer to expiration, that opens me up to additional risk. So I am going to take that iron condor off and then sell a new iron condor using my initial entry criteria, meaning that I'll be selling an iron condor in the next 60-day expiration cycle, or closest to 60 days to expiration at the time of closing the previous iron condor position. A time-based exit trigger is somewhat of a safety net because it gets you out of trades that are not working for you or against you in a significant manner, and that allows you to reset the position using the initial entry criteria that you use in your trading plan. The Tastyworks trading platform just added a days open column so you can see exactly how many days you've been in each position in your portfolio, and that makes it super easy for me to track how long I've been in each of my trades, which makes the time-based exit trigger very easy to track. If you'd like to learn more about Tastyworks and their commissions and fees, be sure to check the link down in the description below. It's worth mentioning that all 4 of these triggers have one thing in common, and that is that they are quantifiable and easy to track. With a profit and loss based exit, you are tracking the profit of your position. With a delta based exit, you're simply looking at the delta of whatever option you're tracking to determine when to exit that trade if that delta based exit is hit. And with a time based exit, you're simply looking at how long you've been in a position and basing your trade exit based on that. Having quantifiable rules to determine when to exit trades is the name of the game, and you don't have to use these triggers, but I encourage you to come up with trade exit rules of your own that are quantifiable and easy to track. And if you do that, I can almost guarantee you will be happier with your trading strategy, and you will find more and more consistency because having rules takes the emotion out of the game and turns you into an options trading robot, which is the goal. Options trading tip number 7 is log your trades. Everyone hates the idea of keeping a trade log because I know from experience it can be an extremely tedious activity, but it's definitely worth it because if you don't track your trades, you're gonna have no idea what strategies are working for you and what strategies are not working for you. By tracking your trades and keeping a trade log, you can measure the strategies that you've been trading and see what's working for you, see what's not working for you. By using a trade log, you can determine why a trade may be working, why a strategy might not be working, and from there you can adjust. There's a link down in the description where you can download a trade log spreadsheet template that I've created for you that you can download for free and use as a starting point to see what you should include in your trade log. And when you're creating a trade log, I would highly recommend automating or calculating all of the columns that you can so that once you input your data, certain metrics like the profit target or the loss target automatically update for you and you don't have to manually calculate those things each and every time. So make it as easy as possible for yourself by calculating as many columns in your trade log as you can, because that's going to make it easier to update and easier to maintain over time. I know it sucks, but I'm confident that if you start tracking your trades, you will dig up some useful information related to your strategies that you're trading, and you will be able to tweak those strategies based on the information you gather from your trade log, and hopefully that will help your strategy become more consistent and more profitable in the future. Log your trades. Options trading tip number 8 is trim the fat. And that means eliminate what's not working for you and focus more on what is working for you. And as you might gather, that's only possible if you have a trade log, because if you're not logging your trades, you have no idea what's working for you and what's not working for you because you can't quantify your performance of various strategies. I personally believe learning active trading is a process of elimination, meaning you start with everything on the table and slowly over time you experiment with different things and throw out the things that you don't like and simply throw out the things that are not working, and that leaves you with the things that are having decent success, and it leaves you with things that are having success, and you can focus more on those areas and get rid of the stuff that's not working, and that's just gonna help you become a better trader. Options trading tip number 9 is to not be afraid to experiment with different strategies, especially when you're just starting out. The best way to learn options trading, and the most effective way to learn options trading, or anything for that matter, is to get real-world experience. So by experimenting with lots of different trading strategies and approaches, you will learn those strategies and approaches very quickly because you'll have skin in the game and you will be watching those positions like a hawk. And on top of that, I would recommend trying to figure out why those strategies are profiting or why those strategies are losing money on a daily basis, so that you understand on a deeper level how options work in general, because there are certain options trading concepts that will carry over to every single strategy you ever trade as an options trader. With that said, if you have a large trading account to start with and you're just learning, do not open a trading account with whatever you have. Instead, start with a small portion of that, because in the introductory phase where you're experimenting and you're learning, there's a really good chance that you're going to suffer losses, and if you make one big mistake, you could lose a substantial sum of whatever you're starting with, and that's why you do not want to start with a large account if you have the option to. If you're just starting out and you only have a few $100s or a few $1,000s, that's fine. Just understand you need to keep your position very small. If you're starting out, a good way to keep your risk in check is to stick with low price stocks and trade defined risk strategies such as call spreads and put spreads. And by sticking with those types of strategies on lower price stocks, you'll be able to create positions that have very little loss potential, meaning that if those trades go belly up and you lose 100% of the maximum loss potential, you won't lose a substantial sum of money. Options trading tip number 10 is to not overcomplicate things. I see all the time people trying to overcomplicate things, and with options, it's already complicated, but when you try to trade 15 to 20 different option positions in your portfolio, and you're looking at all these crazy metrics and arbitrary numbers to try to figure out when the optimal time to sell an option is or when the optimal time to buy an option is, it's just going to get too complicated, and it's going to be very hard to manage that portfolio, which is going to reduce your likelihood of success. Remember that simple is better because simple is easier to follow. The most common ways I've seen traders overcomplicate things are by trading too many positions and by focusing on arbitrary metrics or trying to find holy grail entry or exit points or even holy grail strategies. By trading more and more option positions, you will inevitably have conflicting outlooks, meaning that you'll have bullish strategies, bearish strategies, and neutral strategies, all of which will perform well in different market environments. But if you have them all on at the same time in the same portfolio, some of those positions are going to profit, some of those positions are going to lose money, and where does that leave you in terms of net profitability? I honestly have no idea, and I've never been able to figure out a way to successfully trade 15 to 20 different option positions, not to mention the fact that it is very stressful to track 15 to 20 different option positions, especially if you're implementing some of the trade exit triggers that I discussed earlier. So personally, from my experience, I have learned that trading fewer positions and increasing the size of those positions and using very, very strict trading plans around those strategies is a much more viable approach to successful options trading compared to trading a portfolio of 10 or more option positions. Personally, I only have 1 or 2 positions on at the same time, maximum, and most of the time it's just one. So I encourage you to just think about that. I'm not saying one way is right or one way is wrong. I'm just saying consider the 2 approaches and see what works best for you. For me, I like my trading to be very stress-free, and that means I need to focus on only a couple strategies that are 100% quantifiable. And for me, trading a portfolio of 15 to 20 different option positions is just never going to work. Options trading tip number 11 is to come up with a trading plan that is 100% quantifiable, as I discussed earlier. The ultimate destination when you're learning to trade options or getting actively involved in the stock market is to come up with a trading plan that leaves nothing up to the imagination, which means you know what stock you're trading, what strategy you're trading, how you're going to set up that strategy, exactly how you're going to size that strategy based on your portfolio size or however you size your trades consistently, when you're going to enter the trades, when you're going to exit the trades, and that's it. So by coming up with those things, you're going to reduce the amount of decisions you make, you're going to make it way less stressful for yourself, and most importantly, you're probably going to improve the consistency and profitability of your options trading. So you have to come up with a 100% quantifiable trading plan at some point, but if you're just starting out and you're in the experimentation phase, as I discussed earlier, it's completely fine to not have a trading plan. Just know that if you're serious about doing this and actually making money consistently over a long period of time, you have to have a trading plan. Otherwise, all bets are off. That's gonna do it on this video for my 11 options trading tips. I hope you learned something and picked up a couple of things that you can apply to your trading to help you become more consistently profitable and just become a better trader overall. Leave a comment down below and let me know what you thought of this video, and if you have any other tips to offer in case someone else is reading the comments down below and you have some insights to share. I'm Chris from projectoption.com, and I will see you in the next video.